Thank you so much, everybody, for joining us this afternoon. We're going to be talking to Tyler Sheff in just a few moments, and he's going to be going over analyzing rental property from two different perspectives. So it's going to be a great webinar. He's going to show you how he figures out whether a property is worth investing in, either by buying it and renting it out or by lending on it. So I'll introduce Tyler in just a second, but I wanted to give everybody on the webinar today an idea of who we are and what we do here at Advanta before I turn it over to Tyler. So I just want to kind of give you an idea of our education and Advanta IRA's experience with self-directed IRAs. My name is Larissa Green. I'm a sales and education director here at Advanta IRA. I've been with the company for 7 years now. I've been doing sales and education for about 5 years, and prior to that I was doing every different part of the business. So I did new accounts, transactions, fair market values, and everything along those lines. And so I'm very familiar with all aspects of the business. We are a self-directed IRA administrator, and so that means that we can help you with your qualified retirement plans, invest in investments of your choosing. And so at Advanta, we see people investing in real estate of any kind. We also see people investing in gold and silver bars and cryptocurrency, farm animals, and single-member LLCs, and also partnerships and different investments like restaurants and breweries. And so we're seeing all different types of private investments here at Advanta. We don't hold anything publicly traded, so no stocks, bonds, and mutual funds. We've made it our business decision to help people, those that want to invest outside of the market, whether it's just for diversification or if they truly do not want to be invested in the market. We don't sell any investments at all. Our clients are bringing us the investments that they choose, and we help them make sure that it's properly titled, and then we handle the record keeping for them. We have 2 offices. We're here in Largo, Florida, and we're also in Atlanta, Georgia. The Largo office handles all of the back office or corporate work for both offices, and then in Atlanta, we do sales and marketing, much like we're doing today. So out of Atlanta, we do lunch and learns and seminars. We also teach continuing education classes for real estate agents, CPAs, and attorneys, and they also host webinars out of the Atlanta office as well. So they can help you much like we can help you here in Largo. Advanta does not give any legal, tax, or investment advice. We're here to talk about basically the rules for self-directing your IRA and kind of give you guidance on IRS Code 4975 as it pertains to self-directed IRAs and prohibited transactions within those accounts. But if you have questions, something along the lines of, Larissa, is this a good investment? Am I making a good deal here? We can't help you with those, but many times we can refer you to professionals that might be able to help answer those questions. And so if you're not sure where your question falls, ask it anyway, and we'll put you in touch with professionals that can help you make decisions. Since I didn't mention it yet, we will take questions all throughout the seminar, so please do feel free to type them into the chat box. I am going to keep it muted, but please go ahead and type your questions into the chat box, and then we will get those questions answered as we go. So why haven't you heard of self-directed IRAs? Well, there's just not a whole lot of companies out there that will hold private investments like Advanta does. So as I mentioned, we've made it our business decision that we want to hold private investments only, so we can't, although we could help you with something that is publicly traded, we have chosen not to. So that is just not our wheelhouse. And what we do instead is hold those assets that other administrators like Charles Schwab, Fidelity, Morgan Stanley, although all great companies, they've made it their business decision that they don't want to hold things privately invested. So they're not set up to do things like receive rental income, pay expenses on behalf of a rental company, maybe receive interest payments for a note or mortgage, or do help clients with valuations of those what they consider hard to value assets. And so that's where we come into play. And because there's just not a whole lot of companies out there like Advanta, less than 2% of all investments, retirement accounts, including pension plans and the like, are truly self-directed. So you're going to see there that they're just not out there. So I like to kind of go over the different types of accounts that can be self-directed. And the reason that I do that is because many times when I talk to people, they ask me, hey, you know, I don't have a Roth account. Can I still self-direct my retirement account, or does it have to be converted to a Roth account, and then I have to pay taxes to do that? And the answer is no. I don't know where that sort of came from, but truly a Roth IRA is not the only IRA account that can be self-directed. As a matter of fact, it's anything that ends in IRA, and all qualified retirement accounts, many times it is based on whether or not you've left service with an employer, but basically you can do that as long as they allow you to do it with an employer's plan. But anything other than that, as long as it ends in IRA, can be self-directed. And so if you have a Roth or a traditional, of course those can be self-directed into things like real estate. But also if you have some sole proprietor or self-employed types of accounts like a simple, a SEP, or a solo or individual 401k, those can be self-directed as well. I also have up here health savings accounts and education savings accounts because the rules for self-directing those are the same. And so you are able to use those types of accounts with Advanta, and we can hold those and help you properly title them when you're making investments. And so if you have questions on if you're currently employed and you have an employer's plan you'd like to self-direct, you will have to check in with the administrator for those plans to see if they'll allow you to do what they call an in-service rollover. Otherwise, we can help you with those funds. Again, I just want to mention, if you have questions, just make sure you type them into the chat box and we'll get those answered for you. So I just wanted to go over the types of investments we see as far as real estate is concerned, because Tyler's going to be covering real estate today, and like I mentioned, there's all different types of investments out there, but real estate is the most common investment we see, and so we will cover those types of investments today. Rental property is the most common investment we see, and so people, whatever they like to invest in outside of the IRA is typically what the strategy that they're moving over to their IRA. And so if you like to invest in 3-2s or condos, duplexes, multifamily of any kind, you can do that with an IRA. And we also occasionally see commercial property. Sometimes, partnerships are formed and people are getting together to invest in commercial property. But you can also do fix and flips. And so those are allowed. There's no rule that says you have to hold a property, for example, for a year and a day prior to selling it. If you buy a property today and you find a buyer for it tomorrow, that is an investment you can make with your IRA. And also, I just want to mention that there's nothing in the rule that says your property has to be income producing. So I do have clients that hold vacant land just for the appreciation, and their strategy is to sell it over time so that they don't have to deal with tenants, toilets, and termites. So, we see all different types of strategies here at Advanta. The biggest thing that I run into is people say, I wish I had met you 6 months ago or a year ago because I did use my 401k to invest in real estate, but unfortunately they've taken a distribution of that account. And so that does happen a lot of times where they know that they have funds in those retirement accounts and they want to invest them in real estate. They have a great deal. They're approached with a good deal. They find a good deal. And so what they do, because they don't know about companies like Advanta, is they take a distribution of that account and they use those funds then to invest personally into real estate. And unfortunately, you're losing a lot by doing that. You will first, right off the bat, if you're under the age of 59 and a half, you're going to pay a 10% penalty for taking a distribution, and that's true of any type of retirement account. So if you take a distribution of $100,000 right off the bat, it goes down to $90,000. And then from there, if it's a pre-tax account, it's going to be taxable as ordinary income to you, and you're going to pay 20 to 30%. And if you have a Roth account, you have to look in those rules because there are going to be penalties that apply to any earnings that you have in that account. But going back to our example, if you had $90,000 in there and you pay normal, and it's taxable as normal income to you, you're going to lose 20 to 30% off of that. And so you're looking at now losing all that buying power as well. So now you have $60,000 to $70,000 to invest instead of $100,000. And then on top of that, you are going to find that your income is now taxable. It might be considered passive income depending on the way you use it to invest, but it's still going to be taxable as income to you. I just had a question pop up on using an HSA to invest. That's a great question. All of the things that we talk about here are going to apply to an HSA. So you can use that HSA to invest, and the rules are going to be exactly the same. So you can transfer in an HSA just as you would an IRA, and then sign those investments for an HSA account just like you would an IRA. So what Tyler is going to talk about in the case study that I'm going to use, we may refer to those accounts as IRAs many times because that's the more common type of account, but all of it will also apply to an HSA as well. So great question. So I'm going to turn everything over to Tyler in just a second, but I wanted to give everybody an idea of how it works with investing through an IRA or an HSA, as we just discussed, and what the process is, because I think that really gives everybody an idea of truly how simple it can be when you're using IRA funds. So if you are an investor, you've made investments before, you're going to be very familiar with this process. The biggest difference is the funds are coming from the IRA, and technically the owner of that property is the IRA as well. But again, Advanta has nothing to sell you. And so you're going to go out there and find that investment. You're going to come up with a strategy. You're going to come to us and say, okay, I want to buy a rental property, or I want to lend money on a rental property. And then we're just going to take you through that process with the funding ultimately coming from the IRA account itself. So here in this case study, I have Susan, who has an old 401k plan. Again, if you're currently employed and you want to use your 401, you just have to check in with them and see if they allow you to move it over to an IRA. But in this case, Susan has an old 401k with $120,000 and she wants to buy real estate. She's going to find the property and negotiate the price at $85,000, and she also determines that there will be $15,000 worth of repairs that are going to be needed on that property. So Advanta doesn't do any of those things. Susan is going to do it, or she's going to work with her agent to negotiate the price and determine the repairs. And then once it's rented, she estimates she'll receive $1,000 per month rent back to her IRA. So what does that look like? Well, Susan is going to open and fund an IRA account. She found the investment, so she's going to let us know, hey, I have an investment. I'm going to put it under contract. She made the offer in the name of the IRA, so that's very important. It's not in her personal name, but in the name of Advanta IRA Services, LLC, for benefit of Susan's IRA number 1234. Once an agreement is made on the purchase price of that property, she'll send the contract over to Advanta, and we'll sign it on behalf of her IRA. And then from there, Susan is going to let us know through a form we have her complete called a purchase authorization form what agent she's working with, title agent, closing attorney, and anybody else involved in that transaction, so that we know we're going to be working with those individuals and companies as well. And then as long as Susan has approved everything with her signature, then on the day of closing, we're actually going to sign all the documents on behalf of her IRA, and then at that time, we will wire the funds over to that agency that's doing the closing, and we'll do it. We usually treat everything as a mail away, so we'll go ahead and do that, and then the purchase is complete. Once the purchase is complete, the IRA is going to pay all expenses, receive all of the income, and do the IRS reporting on behalf of Susan's IRA. So we handle that. That is our role as your record keeper, to hold all of those records for you and pay the expenses, receive the income. Now, certainly Susan can hire vendors that she feels comfortable with, that she prefers on any repairs. She can work with the contractors that she wants to work with, but we are going to pay those vendors and contractors, and she's just going to let us know, hey, I have an expense coming up. How do I get that expense paid? We have her submit the invoice over to us, and then we cut the checks directly from her IRA. Now, if she asks us to, we can certainly send the check to her or have her pick it up here at our office, so that once the work is complete, she can make sure that it was done to her satisfaction before going ahead and signing over and giving that check to the vendor upon completion of that work. And then when she has somebody renting that property, what she wants to do is go ahead and have those tenants make checks payable directly to her IRA. And so they will be made out to Advanta IRA, FBO, Susan's IRA number 1234, or they can leave her name off and just use her account number. And once those checks are submitted to us, we will go ahead and deposit those checks into her account. And Susan can keep track of those deposits and any funds that are distributed from her account based on expenses by our email system and also online statements. So she has access to that information just about in real time. We basically update the system at the end of every day. Just some things you guys should be aware of if your IRA is short on funds. I won't go too much into it because we can really talk about self-directed IRAs for 5 hours instead of 10 quick minutes. But basically, you can use partnering where you can partner with other IRAs. Some people who are disqualified to you, you're still able to partner as long as you're making that investment new to you and new to them at the outset. And you can also borrow, so borrowing via a non-recourse loan. You can make an annual contribution as long as you're eligible. So you do want to keep in mind that when you're making this investment, you have some strategies to that you can use in order to make up for, shortage of funds, but keeping in mind what you're going to need on the short term in the very least for that investment when you're making it. I had another question pop up here. Can you buy rental property in a foreign country? You can, actually. I do have clients that own vacation rentals in Costa Rica, for example, so it is certainly something that you can do. What you want to do is just check with that country and see what their guidelines might be for you making those investments, because that's something that we can't help you with. You're basically going to come to us and say, hey, this is okay, they allow it, they just need to see this paperwork or that paperwork, or in some cases we've seen countries require that you have an entity registered with the country prior to making that investment. So you'll just want to check in with them and maybe get some legal advice on that. And then the next question is, can the property be purchased from myself if I already have purchased it in my own name? And the answer, unfortunately, is no. So the IRS considers anything that you own or that a business entity you own, and that includes disqualified persons directly related to you, as a prohibited transaction. So you have to make a new to the IRA investment from a third party. And with that, I'd like to introduce Tyler. He is a longtime investor, and actually Tyler also hosts a cash flow game here at Advanta on a monthly basis. So we kind of skipped July, but he'll be back up and running it in August. How are you doing today, Tyler?
I'm doing fantastic. Can you hear me okay?
Can you turn it up just a little bit?
Yeah, hang on one second here. How about now?
Yep, perfect. Okay, Tyler, and with that, I will let you take control.
All right, let's get it started. So thank you for having me, and I'm glad to be here. And today I want to talk about how to analyze real estate deals. And this is something that a lot of folks don't teach, so I wanted to cover this topic first and foremost because I think it's very, very important as far as knowing which deals you should look at, whether you're, and this is really going to apply to you, whether you're funding deals or you are investing in an opportunity with your IRA directly. So let's go ahead and get started with that. Let's see here one second. Just want to make sure we can see okay. A little bit about me, just real quick, who I am. I am the host of the Cash Flow Guys podcast. I'm also an educator in that space. I'm a licensed agent, and with a focus in creative acquisition. I prefer to deal with investors. I'm an investor myself. I understand investing in creative acquisition, so that's become our niche. The Cash Flow Guys podcast is about buying for cash flow, right? Cash Flow Guys, that's where the name comes from. My focus, my wife and I are focused that we are buy and hold investors. We are focused on multifamily apartments and non-performing notes. Those are the two types of investments that we prefer to focus on. Let's see here. And, of course, I am what they call a greedy capitalist pig. A lot of our local educators, Larry Harbolt and all those guys, that's their little joke, the greedy capitalist pig. It definitely falls in there. I want to get out there and make money so that I don't have to work the rest of my life like everybody else, right? So today we'll talk about what we're going to learn. We're going to learn how to analyze a rental property opportunity, first off. We're going to learn how to decide whether we should keep it or flip it, right? A lot of times this is a tough choice. Sometimes we flip things that we probably should have kept, and sometimes we keep things that we probably should have flipped. I've been down both of those roads. So today we're going to talk about that and go break down a deal, an actual deal. This is a real deal that's happened right here in the Pinellas County area in St. Petersburg. And we'll look at that deal and see how it lays out. Also, we're going to talk about briefly how to use leverage with your IRA. I know, Larissa, you touched base on that for a minute there. We're going to go a little bit deeper dive into that and how you can actually use your IRA in different ways that you may not have thought of before. I'm going to start with a couple myths that relate to IRA investing. Well, this is what I hear a lot is I don't have enough money in my IRA to buy a property, which It's true for a lot of for a lot of investors. You start your self-directed IRA. Let's say you've rolled over a 401k from an employer or something like that. Maybe you just started with the minimum contributions. You can only do so much per year, depending on how you're structured. And obviously, it's not enough. Doesn't seem to be enough to go out and buy a property. Your IRA standalone, buy a property all by itself. It's not like you can go down to Bank of America and say, "Hey, Bank of America, can you loan me 97% of this property like we would if we were going to move into it, like an FHA mortgage or something like that." A lot of folks, there's not a lot of lending opportunities available to IRAs. We'll talk about why that is in a second, but we'll also talk about how to overcome that here in just a moment. One of the myths, a lot of folks have not even heard of a non-recourse loan. They're not sure what a non-recourse loan is. So just to quickly cover that, it basically means an IRA cannot personally guarantee anything because it's not a person, it's an entity. So based on that, it cannot sign a document that says it takes responsibility. So in the event, let's say your IRA has a problem for whatever reason, can't continue to make the payments on the mortgage. In that case, the asset, whatever you bought, would go back to the lender. So if I'm your bank, for example, I'm Bank of America, and I give you a non-recourse loan, in the event that you can't come through, you basically, the IRA signs the property back over by foreclosure or deed in lieu or however it happens, signs it back over to whoever loaned the money. It's called a non-recourse loan. And then I could not go after the IRA for any sort of damages or anything like that because it's an entity, right? It's not a person. Like if Tyler Sheff signed on the mortgage, it didn't follow through, you could put it on my credit report, you could haul me into court, you could do all these things, but with an IRA, you're not going to have that same luxury. So to a lender, that creates an extra element of risk, right? They don't have the same leverage, so to speak, over the IRA as they do a private person. And a lot of people think that means that you can't use an IRA, you can't borrow with an IRA, which is absolutely not true. Another thing, that myth that we hear is it's okay to leave money sitting in your IRA, and it's not going to go anywhere, granted, but here's the thing you have to understand. Your IRA is there to make money. So the government, the IRS, has said that it's okay for you to self-direct your retirement plan. That said, if you just take your money, your retirement money, you put it in your IRA and let it sit there, what's going to happen is, although the balance maybe remain the same, but the problem is your buying power diminishes over time. One of the things you have to factor in is the fact that over time, inflation reduces the buying power of your dollar, right? So over time, the cost of everything goes up. I think we can all agree on that. You go buy a bottle of water this year, it'll cost you $1.25. You go buy it next year, it'll cost you $1.35. So as time goes on, your money, the buying power of your money diminishes over time. So we want to take steps to try to mitigate that a little bit and help your money go farther. So that said, when you have an IRA, a self-directed IRA, the whole idea is to keep your money moving, right? You got to keep your money out in the field working. Think of like little soldiers. They're out there doing their thing. They're out there working. It's very, very important that you keep them working, because the minute they're sitting idle, they're losing buying power. As long as your money is earning a return that outpaces inflation, then your retirement account continues to grow. The worst thing you can do is to have money just sitting there doing absolutely nothing, because that money is going to start eroding based on inflation. When it comes to a buy and hold deal, there are things that are negotiable and there are things that are really not negotiable when it comes to analyzing the deal. Now, obviously, when we're out negotiating a deal or out looking at a property, I suppose everything's negotiable, correct? You've had Advanta's. What I love about Advanta is they provide some amazing education, and more importantly, they provide some pretty talented educators, one of them being Peter Fortunato, probably the most brilliant minds in real estate. And he's a guy that is quite the negotiator. He does some amazing things, trading and doing all kinds of things to put deals together. But when you're analyzing a deal, when you're actually looking at a deal, now, you could be looking at a deal for a couple different reasons. You could maybe be considering looking at a deal to invest in with your IRA. Let's say you meet somebody at a local function and they buy rental property and they hold it for the long term, and you're looking for a long-term solution for your IRA money so you don't have to keep moving it in and out, in and out, in and out. So let's say you want to invest in a rental property and you don't have enough money to do it yourself, but you want to help somebody else buy one. Let's say you're going to loan them down payment money, or maybe you're going to loan them the whole thing. Who knows? But when you're looking at these deals, it's important to understand how they're going to make their money, how they're going to make their profit, or, and the most important question is if they're going to make their profit, right? Because in the event that they cannot profit, or they don't profit, or they're not conservative enough in their underwriting when they're looking at the deal, they could very easily have a difficult time making the payments, and that's not a good place to be in if you're the one loaning the money on that, of course. So to alleviate this, having this education, being able to understand and get a better understanding of what a deal should look like and what makes sense is going to help you get protected and stay protected on this. So as far as what's negotiable, the initial market value, well, that really comes down to what the buyer is willing to pay, right? Market value is tied to what somebody's willing to pay. If you're going to buy a single-family house, it also depends, the value depends on what the appraiser, especially if you're using a mortgage, if you get an appraisal, the appraiser is going to give an indication of value. They are going to use comparable sales methods usually, right? If you're buying multifamily property, and in my opinion, any rental property, I believe the value is tied to the income it generates. More importantly, the net profit. Because if a property loses $500 a month, if you invest in a property that loses $500 a month, is it still worth $200,000? And most people would say, no, it's not worth $200,000 because I don't want to give up $200,000 to lose money every month. However, if it makes $500 a month, well, now we have a different conversation, of course. So let's look at the things that we can negotiate and we can change around when we're trying to analyze a deal. And it starts with the purchase transaction itself, is the purchase price. Right? You can always negotiate the purchase price. It can go up, down, sideways, which have you. That is always a point of negotiation on any investment property deal you're looking at, whether it be a flip, a rental, whatever. The second thing are the terms. Excuse me. The terms as far as how you're going to pay for it. Let's say, for example, the investor is coming to you saying, hey, I want to borrow $100,000 to buy this rental property from you, let's say. Let's look at this deal. I want to borrow $90,000, and I'll give you a 20% return on your money. Well, the deal can't afford that, you see. So realistically, they're promising more than what the deal can afford to pay. And these are the things you have to look at. Now, every rental property opportunity stands by itself because there are different terms and different situations on every single property. There are different expenses. However, understanding how these expenses lay out make a massive difference over how successful you will be, whether you're buying it yourself or you're loaning money. So keep in mind, and this is the one thing, a big mistake that people make is they try to change things like income and expenses. Well, I'm going to manage it myself, therefore I'm not going to allow for property management when I do my underwriting. Don't fall into that trap. That's one of the biggest traps, is maybe cutting some of the expenses or maybe embellishing on the income a little bit. When you see properties advertised, they do a thing what they call pro forma, right? Pro forma, we'll talk about here in a minute. What that basically means to me is, I'm guessing, we don't know, right? We're going to check. What's not negotiable, which you cannot change, is the rents. Okay, right out of the back. The income is the income is the income. And one of the big mistakes that people make is they base what they're going to pay on a property based on what it will do at some point in the future. Well, if you do that, that can get kind of scary and dangerous, and here's why. What if it doesn't do that? What if that projection was incorrect? You have to ask yourself, is that how I want to base the purchase price? Do I want to reward the seller for not getting full value out of this property as far as how much income it generates? And again, remember, the value of that property is tied to the income it generates. So if the income is off, well, we have a big problem. Let's see here. Can you see okay now, Travona? Just want to make sure we're seeing everything. But the expenses are another thing that you really can't get around. The expenses, they are what they are. You're not going to get around the fact that you have to pay, and you should insure your property. I suppose you don't have to insure your property, but you should strongly consider insuring your property. Cleaning and maintenance, this is a fact of life. These are things that you're going to have to clean, keep the property clean, or pay someone to do it. You're going to have to maintain the asset. If you don't maintain the asset, whether it be you or the person you're loaning the money to, then it will fall into disrepair. Tenants will move out. Income will suffer. You will experience things like vacancy loss. speaking of vacancy loss up at the income section, don't overlook vacancy loss. Many people say, well, and sellers and brokers alike will say, well, you don't have to worry about vacancy loss. This thing's been rented solid for 3 years. Well, what happened 4 years ago? Was it vacant then? And to ask that question. I assure you that if you don't allow for vacancy loss when you're looking at or analyzing a rental property deal, you will lose money. I guarantee you will lose money if you leave off vacancy loss. If you're flipping houses and you don't allow for holding costs, which are a little different than the expenses mentioned here for rental property, but also very similar. For example, if you borrowed maybe some hard money, you've got a partner in the deal, and they want a certain return per month while you're getting done or busy flipping this house. Well, there's a cost that goes along with that, and you have to factor that in. Going back down to expenses, management fees. If it's a rental property, and this one's probably the most common thing is, like I said earlier, I'm going to manage it myself. Well, the question I have for you then is, do you work for free? And what if, heaven forbid, something happened to you? Let's say you got sick. Let's say you got hurt. Let's say you just decided that property management is not your cup of tea, which I decided for myself many, many years ago. You're going to have to hire management. So the question you have to ask yourself is, how am I going to pay for that management? If you did not allow for that management, the cost of that management on the front end when you bought the property, it now becomes a hard expense, and it actually costs you money to have a manager. However, if you factor in the expenses, and please understand that the expenses noted here are just a small example of the expenses I'm talking about. If you factor these expenses in now ahead of schedule, then you will be in a far better position to profit on the deal. It's when you think that you can do things later, that's when you're going to have a hard time. That's when you are definitely going to have a difficult time. I had to move my window around there, folks, so we could make it a little easier to see. I apologize about that. But anyway, taxes, that's another thing. They say you can't escape death and taxes. That's correct. You're going to pay property tax on a property. There's no doubt about it. You have to pay for property tax. Maryland, one of the first things you allow for is vacancy. That's under the income. So you're going to have your gross rent amount. Let's say if it's renting, in this case, in this example, it's renting for $1,325 a month. We're figuring the vacancy loss at 10%, which comes out to $132 a month, which means your operating income before expenses is $1,192. Now, going on down, we've allowed for cleaning and maintenance at $119 a month. We've allowed for insurance at $96 a month. We've allowed for management fees at $179. We've allowed for taxes at $104. So we have total operating expenses of $498. Please understand what you will find in almost every instance, especially when you see these pro forma things come over, is you will find estimations in this case. People will guess at the insurance. Whoever's selling the property will say, yeah, the insurance will run you about, $500 a year, $50 a month tops. So what happens if after closing you find out that it's actually $96 a month? Well, what happens is you just lost half of that, the difference of that, because you were essentially guessing, or you believed the guesses that came over. Same with management fees. Just because one manager charges 10% doesn't mean the manager you hire charges 10%, and also doesn't mean that throughout the year there may be additional expenses that come with management that will be passed on to you as the property owner. For me personally, when we underwrite a deal, we look at a deal to consider whether we're going to rent it or not. I don't use 10% for management. Frankly, I use 15%. And sometimes people will argue and say, well, that's just too high. I'll never get a deal. Well, if 5% of the annual income is too high, then the deal is too skinny to begin with. In other words, if you can't figure 15% for management, and that deal is way too skinny to deal with in the first place, I would personally consider that a high-risk deal. If the property cannot afford the debt, which falls under debt service, which is not included in these two sections right there, but the debt is the other thing that you got to think about, that you're not going to get around that, right? You can renegotiate up at the top when you actually do the purchase, but later down the road, you got to factor in if you're going to borrow money. And the one big mistake that people make is they'll buy a property under one set of financing, and then they figure they're going to refinance at some point down the road. And let's say interest rates go up, or maybe the banks are shortening the term of their lending and things like this. So you have to make sure that you make your money when you buy. You have to make sure you allow for everything in the deal. Now, trust but verify is something I believe brokers and sellers and wholesalers and everybody out there that's selling something, they're obviously going to have a vested interest to produce or show it in its best light, right? They're going to show it as best as it possibly can. We can call it all kinds of things. Fancy word they call it a lot of times is pro forma. I call pro forma means I'm guessing or maybe or something like that. If you look up the Webster's definition of pro forma, it basically says, well, we're probably guessing. So you trust but verify. You take the information you've been provided and you verify that. How do you do that? Well, you call the county and you ask them, hey, when I buy this at this new price, how much are my taxes going to be? You call your insurance person, guy or girl, and you ask them, how much is my insurance going to be? By simply asking questions and doing your own due diligence, you're going to be much better off down the road, and you're not going to get yourself in hot water in that regard. So that's a great way to go. Read the leases, and there's a lot of folks that don't do this, and that kind of scares me, not reading the lease. If you look at your lease agreements, what you will find sometimes is discrepancies between what's reported as the income and what's actual. In addition to that, a lot of folks don't get what they call an estoppel letter. And the estoppel letter basically is a letter that the tenant signs that says, I, John or Susie tenant, I pay $650 a month and my lease expires on such and such, and here's the most important part, and I gave the landlord a $500 deposit. The last thing you would want after closing is to find out that the landlord said there was no deposit, but lo and behold, there was. Or the tenant knows this, and the tenant tries to take advantage by claiming that there was something there that wasn't, or vice versa. So you got to make sure that you read the lease agreement, which is something you'll ask for when you get into the due diligence. Once you've analyzed the deal, you're under contract, you would want to make sure that you read the leases, or whoever you're loaning the money to reads the leases. And you kind of got to stay on top of them and make sure they're doing the right thing and keeping things legit. Verifying those expenses, and this is just a snap from I got off the web from, this is the IRS form for expenses. They just give you kind of a snapshot of what some of those expenses would be or could be, and these are going to vary depending on the type of asset that you're buying, where it's located, and things like that. For example, I usually don't allow for snow removal. Why? Well, because I own property in Memphis, Tennessee, and Tampa, Florida. It doesn't snow in Memphis, Tennessee, or Tampa, Florida, at least not enough to need a snowplow. So I don't allow for snow removal because it's not a normal expense. So advertising, well, I may or may not have to allow for advertising. Sometimes some property managers pass that through as an additional expense. They may give you a discount on the management fee, but then pass on the advertising cost. It varies. So allowing for it up front. Auto and travel, that could be traveling back and forth to the property, checking on things, cleaning and maintenance. Commissions, let's say your property manager is out there finding a new tenant for you, or you use a tenant locating service. They're going to charge a commission. Sometimes it's 50% of the first month's rent, or sometimes it's the entire first month's rent. It varies on what that would be. Sometimes they offer concessions. Some landlords offer concessions to current tenants to help them find other tenants. And in that case, that is an expense, and you have to allow for that. Insurance, we talked about. Legal and professional fees, that could be something like maybe you're hiring an attorney for evictions. Maybe you're redrafting your leases, and that your attorney's going to charge you $500,000, whatever it may be. Management fees are self-explanatory. You should still have management fees built in, even if you are self-managing, so that you have that money set aside. Okay. Here's a good example. I set aside management fees for one of the properties I have here in the Tampa Bay area, where my wife and I happen to live on property. It's a 4-unit building. We live on property. I still allowed for vacancy loss and management. And even though I self-manage this property, those two things, because I had no vacancy loss and I had no management expense, those two things allowed my wife and I to charter a private sailboat with a captain and spend a week in Belize sailing around all the islands out there in the ocean. So, I'm okay with being conservative on my underwriting because it paid for a really nice vacation and airfare and hotels on both ends and the whole 9 yards. So had a great time. Nothing wrong with being conservative. Mortgage interest is an IRS expense that don't necessarily have to write it into your underwriting, but if you want to be even more thorough, you absolutely can. Repairs, think about it. A water heater on a Friday night or a Saturday morning, if you get a plumber out there, Yeah, I know you can buy a water heater at Home Depot for $350, but now you have to get somebody to install it, and that's going to cost you a couple $100. It cost you one price on a Monday morning with notice. It'll cost you a whole different price on a Saturday morning without notice, or 2 o'clock in the morning when water's dripping down into your neighbor's apartments. So keeping a good record of repairs and asking the landlord, previous landlord, if it was a previous rental property, how much they spent is very, very important. Of course, taxes, utilities, and a lot of times say, well, the tenant pays the water. Well, they do, and also the tenant pays the electric bill. I totally agree. I'm sure they do. However, what happens when the tenant moves out? Who pays it then? If you guys are in Florida and you're buying property in the state of Florida, the last thing you ever want is to leave the air conditioning off in the summertime, because you will have a swamp mess when you get back to your property. So you want to make sure that the air conditioning is left on. So you turn the power on, and even if it's at 80 degrees, it helps keep the moisture away. So I'm going to go through here with you before we wrap up the breakdown of an actual deal. Bear with me one second here. Let me switch screens. You guys should be able to see this now. Here's the address up top. This is an actual deal that went on, and it really came down to from the owner, and he bought it as a flip. And then he asked me, he called me, I was his agent, and he says, hey, should I keep this or should I buy it? And let me know what that works out to be. So what we did was we figured out, okay, he bought it. How did he buy it? I got all the information from him. I did this analysis for him. This is what we do for our real estate clients here in Tampa Bay. But here's an example. I'm not sure if you can see the pop-up window or not. If you cannot, let me know. But
it's a little bit, it's a little bit small.
Is it? Okay. Let me open this thing up a little bit. Maybe it gets bigger. Well, it's going to fight me, I guess. Let's see. Oh, I guess it's one size fits all. Oh, well. Anyway, so this is based on a 30-year mortgage. This is your typical investor mortgage. Let's say that I'm the one buying the property and you're the one with the IRA that's maybe lending me the down payment or something like that. So we're going to a bank, we're putting 20% down, and we're going to finance the balance using residential rates over 30 years. So in this example, let's use 5% just as a kind of run-of-the-mill interest rate. But that's going to leave you with a monthly payment of about $386.51. So that said, your first mortgage, your purchase price, let's say, is $90,000. And your first mortgage would be $72,000, meaning that you're going to put $18,000 money into this deal, hard money into this deal, plus any buying costs or whatnot. So let's say you're close to $20,000. Let's pretend that you are the person with the IRA that may be lending this down payment to a buyer. So you're going to want to look at this deal and say, okay, can this person make this deal work, or are they going to go broke in the process and not be able to pay me back? Because I want to make sure that the deal can afford them. So as it's written, without a down payment built in, the property, if you scroll down to the bottom, cash flows $308. Okay, $308. That's net cash flow after debt service. However, we have to build in your second mortgage. Let's say you're going to loan the person the down payment. So let's say $19,800 is what you're going to loan, or $20,000. Let's say, keep it easy. $20,000, and let's say you're going to give them 10% interest back in 5 years. That's going to yield a payment of $175.51. That gives you a 10% return over 5 years. So we're going to save that. Now we've allowed for all of our costs, and then we're going to throw that figure in there. We're going to scroll down and see how much they're going to cash flow. Here's the problem. When you structure it that way, they're going to lose $117 a month. They're going to bleed $117 a month. So ask yourself this question. Is this a deal that you'd want to invest in? Is this a safe deal for your IRA? Automatically, I would say, well, does the person have the ability to pay me the $117 out of their pocket? But the more important question might be, why the heck would they? Does it make sense for them to do that? And are they willing to do this for 5 years? Or are they just going to maybe get sick and tired of losing money every month and walk away from the deal, leaving me high and dry? So these are the type of things you got to look at as the lender. Can the deal afford me? How do we solve this problem? Well, one way we can solve the problem is to loan them less money or change the term, but That's no fun because obviously we're investing with our IRAs to make more money. So how do we maintain our return? And let's say that we decide, this is high risk, so we want to bump this to 12%. Even worse, right? So let's change the term and let's say, okay, well, 10 years. 10 years is great because now I don't have to move my money as much, right? Now I know that for 10 years I'll get my 12% return. Now I bumped it. Well, lo and behold, I have raised the cash flow in this deal to a whopping $21. Still no bueno, right? Still not good. So what do? Well, this is where we come back to our person that we're going to loan money to, and we say, listen, here's the deal. I want to be in this. I'm good with being in this for 10 years because markets fluctuate from about every 7 years. I want to ride out any downturn and come back up the other side, no problem. I'm willing to loan you 20 grand, but I want you to have some of your own cash in this deal too, because me as the IRA being in second position as your lender puts me in a higher position of risk. So here's what I'm going to do. I need you to put more money in the deal. So in that case, we'd change the financing, say to 70% instead of 80% on the first mortgage, and they would have to put a good chunk of the change of their own, let's say $80, $100 in the deal themselves. Well, that yields a cash flow now of $69. Still not exciting. Let's look at this again. Let's go down and say, well, 60%. And what we're doing here, folks, is we're having them use their cash to put more skin in the game to lower the risk perspective on the deal for us as the IRA lender. Well, now it's got a cash flow of $118 for them. Now it looks like a better deal, right? It's a little safer. They're less likely to walk away because if they walk away from this deal, they're going to lose $17,000 of their own money, $18,000 of their own money, in addition to $20,000 of ours. So we can play with these numbers up here, as we talked about at the beginning. We can always tweak these numbers to reduce our risk. Just keeping in mind when you've got a bank mortgage in front of us, that is higher risk. In the event of foreclosure, the first mortgage holder is going to be made whole before the second mortgage holder. So we want to factor that. So let's look at this another way. Let's pretend that we are the first mortgage holder. So we're going to zero this out. And let's say we're in first position. And let's say we want them to put 30% cash in the deal. And let's say that we are willing to give them 30-year amortization terms. And you could still structure this where there's a balloon and they pay you back in 5 years or 10 years or whatever you want to do. But for the purposes of getting to a payment that the deal can afford, let's say we're going to use 30 years as an amortization schedule, 5% interest. And we decide, we don't like 5%. We want 7% on our money and for the long term, and go from there and see how this shakes out. In this case, the deal cash flows $275. Now, for me, that's not all that bad. It's a single-family house, not all that bad. But let's look down and see what else is down here, the rest of the story, as they say. First of all, let's look at the operating expense ratio. Then this factor tells me whether the deal makes sense or not from an expense to income ratio. And right now, it's at about 41%. That's right about where it should be. That tells me that the expenses that are in there are not too high, not too low, kind of right in the middle, kind of a sweet spot. The debt coverage ratio is 1.66. That means at the end of the month, there's some money left over to pay more than just the mortgage payment, right? How this factor helps you. The higher this number is for you, the lower the risk as the lender. So if you see a debt coverage ratio that's below, say, 1.5 or 1.6, that tells you that there's not a lot of money left at the end of the month for this deal. That also tells you if something goes wrong, if they hiccup, if they stub their toe, if a water heater element goes awry, they may have a difficult time paying the mortgage to you. So for me, that would constitute higher risk. I would be concerned. Now, me personally, when I buy an apartment building, this number better be 2.0 or better, which means at the end of the month, when it's all said and done on the wash, I need to clear, after all said and done, after all the debt service, the whole 9 yards, I need to clear twice what the mortgage payment is. So I should be able to make 2 mortgage payments every month if I need to in order for me to do the deal. If my debt coverage ratio is not a 2.0 or greater, I won't do the deal. That's just me. One of the ways you can make this number go higher, or actually have your person you're loaning to go higher, is you can have them bring more cash to the table. Hey, you don't have enough cash in this deal. I need you to put another 5% down or 10% down. You keep tweaking it until it gets to a 1.6 or higher. The banks even are saying these days 1.25 to 1.6. Keeping in mind, Wells Fargo is in a position to lose money. We are not, right? We have to retire. They don't. And of course, this factors your cap rate as well. I don't really use cap rate as a metric, mainly because cap rate does not include debt service and does not include expenses. It assumes a cash purchase. I don't pay cash. I use leverage. Therefore, the metric is of little value to me. The other thing I look at is my cash-on-cash return. So let's say I'm the guy that's buying the property. I want to make sure that the deal can afford the debt service, of course, but more importantly, I want to see what's in it for Tyler. So going back up to the top, in this deal, we're assuming that I've got $28,000 of my own money in this deal. And for my $28,000, I'm getting an 11.5% cash-on-cash return. Only you can decide if that makes sense for you. If you're the one that's doing the deal yourself or you're lending in the deal, you got to kind of look at that metric and say, well, is this person going to be happy with that return over time, or, again, will they walk away from it? If you're the one buying the property, you have to sit down and figure out what makes sense for you as far as a return. And for me, it varies, and it really depends on the risk. For example, if I'm loaning money to somebody that's flipping houses, I think that's high risk. I want a high return. If I'm loaning to somebody who's holding rental property for the long term, I consider that relatively low risk, especially if they're an operator and they know what they're doing. So I would probably give them maybe a lower interest rate. I wouldn't expect as high of a return because there's not as high a risk. But it's totally up to everybody. The assumptions, just for clarity here, folks, is I assumed for all these calculations a appreciation rate of 5%, a vacancy rate of 10%, income and expense inflations at 3%, which admittedly are conservative. Lastly here, there's a picture of the little house. In this example, so the gentleman decided to keep it and keep the house, and here's why. Let's look at the forecast here. So purchase price of $90,000, and actually let me correct one thing real quick so that matches up exactly with what he had. He used a 5% mortgage, and he put 20% of his own money in the deal. And let's see here. Yeah, cash flow of 308. And this is all in, folks. This was his actual deal. And then this included the rehab and the whole 9 yards, what he's in the deal for. At the end of the day, his net operating income was $695 a month. He had a cash flow of $300 cash flow based on a $19,000 investment. Depending on who you are, that could be a really strong return or questionable return. But here's how it shakes out, folks. In the first year, his cash-on-cash return was 18.7%. Not too shabby. Not too shabby at all. Let's scroll down here to the bottom, and I want to kind of show you the forecast. Now, the debt coverage ratio is 1.8. That looks pretty good, right? That's higher than the lowest expectation I would look at, and just under my sweet spot. I like to be at 2.0. His beliefs were different than mine, and that's absolutely okay. Let's look out at 5 years, for example. In 5 years, and here's a 5-year projection, this column, I hope you can see my mouse. If you look at the income analysis, in 5 years, he has made a return on his equity, or a cash-on-cash return of 24% over 5 years. In 10 years, it jumps to 31.5%. That's just on the income, ladies and gentlemen. Let's scroll down. Let's go to the sale analysis. Let's assume in 5 years, and remember, this is keeping in mind that the property appreciates. This is the last thing before we wrap up. Let's say the property appreciates 5% per year. Right now, our properties are appreciating much higher than that, but I use 5% because obviously we know that what goes up must come down. This considers a baseline. Let's look at 5 years, 31.8% internal rate of return. Skip that. The return on investment, ladies and gentlemen, is 212% in 5 years. 212% in 5 years. In 10 years, it's 541%. That's on a $19,000 investment. So at the end of the day, this gentleman invests $19,000 in this property, $19,800, and in 10 years can pull out a net profit of $107,000. Tell me you cannot supercharge your retirement plan by simply buying a single-family house very boring, very vanilla, and hanging on to it. It's that simple. And yes, you're absolutely right, Lou, tax-free. If you leverage that profit back out, if you borrow, and I'm not a CPA, I know we have one on the call, but if you borrow that money back out, that's borrowed money. So as far as I've been told by my CPA, that borrowed money I don't have to pay taxes on because it's not earned income. I only have to pay taxes on money that's earned. I haven't earned it when I borrowed it. So think about that. Talk to your CPA. Use a good certified CPA, licensed CPA, to help you make sure that you can capitalize on the benefits of real estate. Now, I'm not going to go down too far down that rabbit hole, but I have a free course for you folks that will break this down even further. If for those of you that want to get all deep in the weeds, I'm here to please. I will get you there in just 1 second. Let's see here. All right. Lastly, it is a free course on how to analyze deals. It's what I went over, broken up into 4 videos. I went a lot deeper in this course than I did here today because I had a lot more time. Cashflowguys.com/mailbox money. You can put in your email address and you get access to the course, and it's 4 videos that walks you through the process. And I'll send you a couple emails that will explain different things, and you'll actually get a copy of this document that I was showing you earlier, the deal analysis sheet, and everything's in there and all complete. So I had a great time. I hope you guys learned something. I want to open it up to questions if we have any. Let me see if I think I may have skipped over a few, possibly. Let's double check.
I didn't see any pop-ups so far, but I do want to mention, guys, get your questions typed into the chat box. And while you're doing that, I have a question. So I know you mentioned multifamily. Are the calculations that you're using for multifamily and single-family the same here, or are there other factors when you're looking at more doors? Is there something that comes into play there?
They're very similar. The only difference is that in my opinion, well, actually, it's not even my opinion, it's fact. Multifamily property, when it's appraised, if it's over 5 units, the value really is tied to the income. Comparable sales doesn't really matter. So what's cool about that is in a market shift, every time the market drops, rents always go up because of availability. So those of us that own multifamily properties, we make money when the market crashes, where the single-family people don't, right? When rents go up, values go up, and that's the beauty of multifamily versus single-family.
Okay. And then also, I noticed on the sheet you were using, it said realestatetools.com. Is that where you're going to do these calculations, or what tools do you recommend for that?
I've tested several of them. Bigger Pockets has a really good spreadsheet. If you're a spreadsheet person, you can get it for free if you're a pro member on Bigger Pockets. I like this realestatetools.com. And this is called Property Evaluator. It's put out by realestatetools.com. Here's the downside of it, though. It's only available on Apple, the actual app.
Okay.
So the app I was showing you is only an Apple thing. But if you go at realestatetools.com, they do have an online version that obviously works on Windows and every other type of system out there. But I just happen to like this one.
Okay. I saw a question pop up about is there going to be a replay available? Yes, there is. What we do is we'll put it to our YouTube channel, and we'll also blast that link out to everybody that registered. So you will be able to review this again when you have time. So it'll go in those places, but you will definitely get it by email, if not tomorrow, by then the beginning of next week. And we had another question pop up here because you can't get deductions and depreciation with a Roth account. So if one were to analyze the 5 years with one property, all personal or court funds, versus same deal with the IRA, how would that look?
Let's see here. Can't get depreciation. So if one were to analyze a 5 year with one property, I'm just reading it again here. Well, I'm going to have to defer to a tax professional on that one. Analyze the 5 years of the property, all personal or corporate funds, versus the same deal with an IRA. What does she mean she can't get depreciation? Yeah, you can still get depreciation. So there's different tax advantages available, and that's where a really good CPA is a big benefit. And it sounds like we have one here on the call, Marilyn. If you're a CPA, I'm sure she could help break that down for you, because how you're taxed really it depends on the individual taxpayer, as best I know. So the other way to look at this is sometimes you may have an IRA, and obviously it's great to invest your IRA money, but think of IRAs in a different thing. Maybe you go out and buy this property personally, and maybe you have an IRA account holder invest in your deal so that you could glean the tax benefits personally because you'd own the property personally, and you would leverage somebody's IRA, bring them into a deal as either a partner or a lender, bring their IRA into the deal as a partner or a lender. That way you could capture the tax benefits, and maybe you could give them a higher return because you leverage those tax benefits. So that's always an option.
Okay. And if there are no other questions, we're going to end here right on time. Thank you so much, Tyler, for joining us. That was a lot of really good information. We'd definitely like to have you back, talk about maybe some more advanced strategies and other types of deals that you work on through cash flow. And then also I just want to mention again, keep in mind, guys, that Tyler hosts a cash flow game here at Advanta IRA once a month. We'll be back for that game on August 16th. At some point, we'll send out an invite for it, but also Tyler does invites through Eventbrite. Is that correct?
That's correct.
Okay, perfect. Thank you so much, guys. Thank you, Tyler, and we will talk to everybody soon.